All right, traders, let's quickly take a look at the euro dollar. Now, we've had a ton of questions streaming in about the euro dollar, whether there's potential for upside continuation in the recent move higher, or whether it's time to potentially look for downside risks. Now, it's interesting because very recently, a couple of investment banks have also changed their minds, at least from a tactical point of view, for the euro dollar. And we'll quickly touch on why that is and where the balance of risk is currently tilted for the euro dollar. Now, let's start with why we've seen this huge ramp to the upside in the first place in recent weeks. It's been driven by two drivers. On the one side, most of you will have seen the huge fiscal stimulus deal. We spoke about this 2 weeks ago as well. That was unlocked in Germany. One of the biggest fiscal reforms we've seen in a couple of decades, with a 500 billion euro fiscal plan, which finally got its last backing last week. Now, that's been one of the main drivers for optimism on the euro side with that big rush to the upside. But there's also the opposite side of the equation, which of course is the US dollar. So there's been optimism about the eurozone, but there've also been some pessimism about the US, with a lot of growth concerns suddenly coming on the radar in the last just quarter 3 weeks. Some of these concerns came on the back of data points like the ISM manufacturing PMI in the US, which showed us contraction in the main index. At the same time, we had things like inflation measures surprising to the upside. So that is giving the markets a little bit of stagflation fears for the US economy. We've also seen things like business surveys, consumer sentiment, confidence, all pushing lower. A lot of people obviously concerned about the new administration's tariff policies and what that could potentially mean for growth, at least in the short term. We've also seen other measures, things like the Atlanta Fed GDP nowcast, which is basically a real-time measure for quarterly GDP in the US. And we can see that that is currently tracking at close to negative 2%. Now, there's a little bit of a caveat when it comes to this data, because if you account for the massive surge in gold imports into the US as a result of tariffs, if you account for that, then that number is closer towards zero. But still, that means we've gone from close to 3% growth in the US, at least in Q4, to potentially down to close to zero in Q1. So there has been valid reasons for why the markets have been a little bit concerned about growth in the US economy. So it's basically been pushed up by two drivers. On the one side is optimism in the Eurozone, and obviously on the opposite side, there is pessimism when it comes to the US. Now, even though those have been valid drivers for the move to the upside, I do think there is clear reasons for euro dollar bulls to be a little bit cautious here about chasing on the upside. Let's touch on the first reason for that. The first one is positioning. If you take a look at how fast the markets have changed their positioning for both the euro and the dollar, it's been quite staggering. I mean, take a look at where we've gone from a stretched short position in the euro to a massive stretched long positioning in a very short space of time. And this is showing you institutional investors. They've gone from crazy short the euro to crazy long in a pretty short space of time. And the exact opposite true for the dollar. They were as to grass hawkish and bullish on the US dollar a couple of weeks ago. And that has now turned into quite a straight short position for the US dollar. Now, this alone doesn't give you enough reason to short something like the euro dollar, right? You need more than that. But this is showing you that at least from a crowded positioning point of view, the markets might be sitting on a little bit too stretched hands here when it comes to euro dollar upside, and there could be potential for downside risk. That's the first thing we need to consider. The other thing we need to consider is that a lot of this optimism that we've seen built up for the euro dollar has obviously been based on expectations for positive growth in the eurozone versus moderate growth in the US. The problem with this view, guys, is that the optimism that we've seen coming into the Eurozone is based on expectations for the Eurozone to grow, right? We haven't seen the hard data showing us any optimism yet. The markets are expecting some of these fiscal measures to potentially impact the economy from only the middle part of this year, maybe even push back to Q3. And if you've ever watched fiscal developments when it comes to European nations, especially Germany, there's so much red tape, so much bureaucracy, there's so much legislation that needs to go through. It's strange that the markets are pricing in growth or the potential for higher growth, given all of these risks, that it could take a very long time for these things to materialize. So we might be in a situation here where the markets have priced in so much optimism for growth that has not materialized yet and could take a lot longer to actually materialize at all in terms of the Eurozone economy. So that gives us a little bit of reason to be cautious here about chasing the highs in the euro, which is also why some participants have been taking more tactical short positions in the euro dollar to basically counteract the fact that the markets might have gotten a little bit ahead of themselves. Now, there's also another factor that is a risk for euro dollar bulls right now, and that is tariffs. Now, the US administration has obviously backpedaled on a lot of their tariff threats. They threaten, then they remove it. It's all just part of negotiating better deals. We all know that. But the challenge is that the US administration has been really tough and vocal about the tariffs that they're planning to put into motion next week, Wednesday. Now, that is Liberation Day, according to President Trump, and that is where he is expected to put in a lot of reciprocal tariffs. And Europe is expected to be one of the receivers of those big increases in tariffs. So at this stage, given the optimism that's been priced in, one has to argue that maybe the markets are underpricing a little bit of that tariff risk, which is another thing that could pose some downside risk for the euro, potential upside risk for the dollar, obviously downside for the pair, if you will. Now, the other thing we need to consider is that even though some of the US data has shown us that there is some stresses, some reasons to be concerned about US growth, there's also things that came in pretty solid still. If you look at the ISM services PMI, it's still showing expansionary territory. Now, why this is important for us is because services as a share of GDP is about 80% of US GDP. So that part of the economy is still doing fine. Yes, manufacturing is taking a little bit of a slump, and that is something to worry about. And there are signs of stagflation developing. But, looking at services, there's not a lot of fear in this right now. Also, if you take a look at the recent jobs data that we've had, there's really no reason for the markets to be fearful there. And that is why the Federal Reserve last week, and that brings us to the final point, they are still very patient in terms of interest rate adjustments. They told us last week that they are not in a hurry to cut rates. They want to give themselves enough time to first see what's going to happen to tariffs, what's going to happen to the economy, and then they will change their minds. But if you take a look at what rates markets have done, and again, this is talking to that or looking at that optimism for the Eurozone, pessimism for the US, you can see that the markets are currently pricing in a lot more basis points worth of cuts for the Fed versus that of the ECB. I think that is a potential risk that these ones are skewed or should be skewed in the opposite direction. I think there's greater chance that the Fed cuts less than the ECB than the opposite around, right? So if you consider that services is still doing okay, the fact that the Fed has told us that they are in no hurry to cut rates, while the Eurozone or the ECB has told us that they do in fact see themselves cutting more, maybe the markets are just pricing in a little bit too much optimism here, like I said, for the Eurozone versus pessimism for the US. The other thing we need to consider when it comes to central bank policy is take a look at what inflation, forward-looking inflation measures for the US has been showing of potential inflation risks. Now, in orange here, we have a US CPI year-over-year headline. In white, we've got prices paid, and in blue, we've got commodity prices. Now, you don't have to be a rocket scientist here or economist to see that there's clearly a correlation between these things. And recently, prices paid as well as commodity prices have been showing us upside risk for inflation in the months ahead. And again, that is something that should keep the Fed more patient in terms of cutting rates versus the ECB, which is yet another reason to expect more downside risk for the euro as opposed to, or euro dollar, as opposed to upside risk in the short term. So having said all of that, what do we need to watch? What are the key possible catalysts that we can look for to give us an opportunity to trade this? Currently, I'm already short euro dollar, so I am talking my book here, just out of a disclaimer point of view. But some possible catalysts that could provide us with an opportunity to trade this lower, or for those of you who are bullish, potentially trade it up, could be the incoming US data that we have. This week, we don't have a lot of exciting data points. We do have things like the US consumer confidence. Today, we have the S&P Global Flash PMI data. We also have PCE data for the US coming up on Friday, and obviously initial jobless claims on Thursday. If any of these data points should come in much better than expected, then obviously we could look for some potential downside drift in the euro dollar. If they do come out and it's just super ugly, showing us that there is real reasons to fear growth in the US economy, then obviously that can create a little bit of upside. But the preference there would be to look for good data and use that as an opportunity to to expect more downside for the euro dollar. Alternatively, we need to watch any incoming tariff announcements. If we do hear from the US administration that huge tariffs are planned for Eurozone products, then obviously that could be a trigger to expect a little bit of downside pressure there as well. And then the other gauntlet that we need to wait for is next week's US data. We get huge data next week, guys. We have the ISM manufacturing PMI, the services PMI. We have another batch of US data. If all of that data should come out and it paints a more rosy picture compared to what the markets have already priced in, again, that could see a little bit more upside potential for the dollar, a downside potential for the euro dollar. Now, in terms of levels to watch for, there's a couple of things I think we need to keep in mind. For those of you who are still bullish this market, key levels of resistance to watch would be that 5-day moving average. The reason why we watch the 5-day moving average in the first place is, remember, there's only, at least for traditional finance, there's only 5 trading days in the week. So your 5-day moving average shows you 1 week price momentum. That's very important input levels for the likes of CTAs out there, momentum traders out there. So the first level of resistance would be that 5-day moving average or 1 week price momentum. And above that, you have the recent highs coming up at that 109 psychological level. Also, that red line that we see on this chart, that is the weekly implied volatility barrier resistance. Now, that is a very objective way of looking at support and resistance. That is the level that the options market is telling us they think there's a very high probability for price to stay contained within. That is that resistance high and obviously the support low. So that's a very, very nice confluence there. You've got the 109.50, you've got the weekly implied volatility high, the recent highs. That'll be a key level to watch. If we do manage to break above that, key level for traders to aim for above that would be 110 and obviously the 110.50 psychological. What about downside? Downside, key levels to watch. The first one would be that 200-day moving average. Very nice confluence there with the weekly implied volatility low. And if you take a look at that level, that 107, let's just call it the 108 psychological, that's also got pretty stiff support and resistance from prior months. We're going back all the way here to June 24, April 24, February 24, and obviously December 23. So a key level of support there for any bears out there. Once we get there, it's going to be really tough nut to crack and break to the downside. So those are key levels to watch. Those are the key events to watch. And those are the reasons why a couple of participants have shifted slightly more bearish on the tactical side when it comes to the euro dollar. So a lot to focus on. As always, any questions, don't hesitate to let us know.